Three of the most famous stocks in this country are down big right now, and one of them has lost over 40% of its value since its high. And here's the part that ought to bother you. You probably own at least one of them. Not because you picked it, because it's sitting quietly inside your index fund or your 401 kilobits, and you've never once looked it in the eye. Right now, all over the internet, people are staring at these charts and doing the single riskiest thing you can do in this business. They're buying the dip on a name they love with no earthly idea whether they're picking up a bargain or catching a knife on the way down, and those two things look exactly the same for about the first 10%. That's the cruel part. I want to talk to you today about three stocks: SoFi, Palantir, Microsoft, household names, all three. And I'm going to walk you through a little system, a real simple one, that tells you which of these is an actual opportunity, which one you ought to leave alone for now, and which one is quietly bleeding money out the bottom. This isn't something I dreamed up over coffee. It's the same basic logic the big desks use, just with the jargon stripped out and put into plain English. So stick with me, because by the end of this, you won't just know what to do about these three. You'll know how to look at any beaten-down stock for the rest of your investing life and tell in about 90 seconds whether it's worth your money. Now here's the misconception that trips up almost everybody, myself included. Back when I was starting out, we think a falling stock price is a report card on the company. It isn't. I lost real money learning this the hard way. Years ago, buying what I was sure were wonderful businesses, watching them slide 15, 20, 30%, and thinking, well, it's a great company, so it has to come back. Sometimes it did. Sometimes it just kept sliding, like a shopping cart with a bad wheel, and I chased it the whole way down. What I didn't understand back then is that a stock price isn't measuring how good a company is. It's measuring two completely different things: what people expected versus what's actually happening, and where the big money is choosing to go shopping that particular week. Here's a picture that helped me more than any textbook ever did. Think of the whole stock market as one giant bathtub. The money in it doesn't leave the tub. It just sloshes. It sloshes toward chips one month, toward banks the next, toward whatever the crowd has decided is exciting right now. And when the water sloshes away from your corner of the tub, even a genuinely excellent company can be left sitting in the shallow end, dry and exposed, through no fault of its own. The fancy term for this on Wall Street is sector rotation. Forget the term. Just remember the bathtub. Water moving from one end to the other. That's basically the whole idea. So when you see a big name down 40% and your gut screams bargain, here's the honest truth. Down a lot by itself tells you nothing. A stock can fall because the water briefly drained out of its corner of the tub, or it can fall because the company is genuinely in trouble. From the chart alone, on the day you're looking at it, those two situations look identical, but 6 months down the road, they end up in completely different places. One recovers nicely, the other keeps going and takes your retirement fund with it. So the whole game is figuring out right now, today, which one you're looking at. Think about it the way you'd think about a grocery store. Say your favorite little market down the street suddenly has half-empty shelves. Now, that could mean two very different things. Maybe there was a truck delay, and the good stuff is coming back Thursday, in which case, smart move, you go in Wednesday and stock up before everybody else notices. Or maybe the owner's retiring, the lease is up, and this store is closing for good. In which case, those empty shelves are the beginning of the end, not a temporary dip from the sidewalk. On any given Tuesday, those two stores look almost identical. Half empty, a little sad, easy to walk past. You only find out which one you're looking at by actually stepping inside and checking. That's exactly what we're about to do with these three stocks. We're stepping inside. I had a long walk with an old friend of mine a while back, a fellow who spent decades on a trading desk, and I asked him how the professionals actually make this call. And he said something that stuck with me. Inside a real bank, nobody's making this decision off a gut feeling. It's a checklist. Same three questions every single time, no emotion involved. And he walked me through it, and I realized I could hand this exact same checklist to a curious kid and they'd be able to use it. Matter of fact, I've laid a version of it out at my own kitchen table for family, and it held up just as well there as it does on any trading floor, because a good rule doesn't need a fancy vocabulary to work. So here it is. 3 questions asked these every time a stock you love takes a beating. Question 1. Is the money still flowing into the neighborhood? You don't just look at the one stock, same as you wouldn't buy a house without looking at the block it sits on. You look at the whole industry around it. If the entire neighborhood is being abandoned, it barely matters how nice the house is. Nobody's coming to look at it. Question 2. Which side of the trend line is the price sitting on? I like to use what's called the 150-day moving average, which sounds complicated but really isn't. Think of it as a speed limit sign for the stock. When the price is riding above a line that's climbing, you're driving in the clear. When the price is stuck below a line that's dropping, you're out on black ice and you don't know it yet. Question 3, is this stock resting or is it crashing? Every strong stock takes a breather now and then. That's healthy. That's normal. Athletes rest between sprints too, but a real breakdown looks different. Heavy fight and selling on huge volume, that's not a rest, that's a stampede for the exit. I like to picture question 2 a little differently. 2, closer to home. Picture a family driving cross-country, and the kid in the back seat keeps asking, are we there yet? You don't answer by looking out the side window at a single tree. Going by, you look at the road sign, the mile marker, the general direction you've been heading for the last few hours. One tree tells you nothing. The trend line is your mile marker. It's not perfect, and it won't tell you the exact moment you'll arrive, but it tells you broadly whether you're getting closer or further away, and that's worth a lot more than staring at one tree and guessing. Once you've got answers to those 3, you get a color. Green means money's coming in, the price is riding above a rising line, and you're in a genuinely good spot to be. Amber means it's mixed. You might have a wonderful company caught at the wrong moment, and the smart move is patience, not action. Red means the money's fleeing the neighborhood. The price is stuck under a falling line, and the volume looks ugly. That's your falling knife. Painful to grab, even more painful to hold. That's the whole test. 3 questions, 3 colors, 90 seconds. And you can run it on any stock on the planet. My friend, the one who walked me through this, I put it in a way I still think about. He said, cheap is not a strategy, and neither is hope, but a checklist you actually run every single time. That's a strategy. Because it doesn't care how you feel that morning. Now let's actually use it. Start with SoFi as of this recording. The stock is trading somewhere in the high teens, down roughly 44% from its 52-week high near $33. And yes, it's been a rough ride if you were holding it the whole way down. I owned this one myself a while back, and I had a rule for getting out, and I used it, and I'm glad I did. So let's run the checklist, honestly. Question 1, is money coming back a little? Yes, compared to where it was a few months ago, the neighborhood is looking a bit less abandoned. Some institutional buying has crept back in. Question 2, which side of the line? The price has clawed its way back above its short-term trend, but the longer 150-day line hasn't fully turned up yet. So it's a bit like watching somebody climb out of a hole. They've got their head above ground, but they're not standing on solid footing yet. Question 3, resting or crashing? It looks like it stopped falling and started stabilizing, which is a good sign. But stabilizing isn't the same as confirmed strength. So where does that put SoFi? Somewhere between amber and green. It's on my watch list, not my buy list, yet. I'd personally want to see it push back above its recent highs before I'd call this confirmed, because just because the worst appears to be behind something doesn't mean it actually is. Now here's the one that's going to make some of you a little annoyed with me. Palantir. This is one of the most beloved names in the whole market right now, and for good reason. The business itself has been genuinely remarkable. Revenue growing at a pace that would make most companies blush. Real demand from real customers. I owned it myself for a stretch. Don't right now. And it's down hard, somewhere in the neighborhood of 40 to 45% off its 52-week high. The faithful are out there right now shouting, buy the dip. And I understand the urge completely. I love the business too. But loving a business and owning the stock at the right moment are 2 very different exercises. Let's run the checklist anyway, because a beloved company doesn't get a pass on the questions. Question 1, is the money still there? Surprisingly, yes. The crowd hasn't fully left, and the underlying business keeps posting strong numbers. Question 2, which side of the line? Here's the problem. Despite all that affection, the trend has genuinely rolled over. The price sits well below its longer moving average, and that average is still pointed down. That's a real red flag, not a feeling, an actual signal. Question 3, resting or crashing? It's been more of a grinding slide than a sharp panic, but it's still sliding. So where does that leave Palantir? At best, an honest amber, and by the stricter reading, closer to red. Great company, rough moment for the stock. And here's the hard lesson buried in there. You do not buy a beloved stock just because it's beloved and cheaper than it used to be. You wait for the tide to actually turn, for that line to flatten and climb again, and then you act. Yes, you might miss the first 10% of the eventual recovery. Good. That missed 10% is basically the insurance premium you pay to avoid catching a knife that has another 20 or 30% to fall. Missing the first leg of a rail rally has never once ruined anybody. Catching a falling knife on the way down has ruined plenty of people. And now, the one that'll get me the angriest comments of the day, Microsoft, the biggest, most respected software company on the planet, by most measures. Hundreds of millions of paying customers across Office, Windows, and Azure. one of the single largest bets on artificial intelligence infrastructure of any company alive. Someday, I genuinely believe this current dip is going to look like a gift in hindsight, and I would love to own more of it at the right price. But here's the trap. With a company this respected, the temptation is to assume any drop must be a screaming buy. That's what half the internet is telling you right now. Let's not guess. Let's run the same 3 questions we ran on the others, because Microsoft doesn't get a pass either. Question 1, is money flowing in? Actually, no. Relative to the broader market, Microsoft has been lagging, showing up as one of the weaker names among its own peer group of giant tech companies, and the water in our bathtub picture is quietly draining out of this corner. Question 2, which side of the line? This is the killer. The stock is trading below its major moving averages, with a longer-term trend still pointed downward. By the standard reading, a company this great is sitting in its own private bear market. Question 3, resting or crashing? This isn't a sharp panic, it's a slow, grinding decline that's dragged on for months. So put it all together and what do you get? Red. The greatest software company on the planet is, at this exact moment, technically a falling knife by the rules we just laid out. Now, some very smart, very famous investors are buying it anyway, and other very smart, very famous investors have been betting against it. Nobody is right all the time. On either side, I'm not telling you to sell it. If you own it through an index fund, which most of you probably do, you already own it. And that's fine. I'm just telling you what the rules say about starting a fresh position today. Not yet. The signal that would flip this back to green for me is simple. The price reclaiming that longer moving average, the line itself turning back upward, and real volume showing the money is flowing back in. So the day that happens, I buy. Until then, I watch. So there you have it. 3 of the most famous companies in the country, all down, all sharing the same scary headline, and 3 completely different honest answers underneath it. SoFi, early and unconfirmed, worth watching closely. Palantir, a wonderful business caught in an ugly amber worth waiting on. Microsoft, a phenomenal company that is, by the numbers, currently a falling knife, worth respecting rather than catching. And I want to be straight with you. I'm not a licensed financial advisor. I'm not managing your money. I'm just an old stock watcher walking you through how I personally think about these things. You have to make your own call. Now let's talk about why this is so hard to actually do with your own money. Because knowing the rules and following the rules are 2 very different muscles. The trap here isn't intelligence, it's emotion. Fear tells you to sell everything the moment a headline scares you. Greed tells you to back up the truck the moment a favorite stock gets cheaper. And the herd, the crowd, the comment section tells you that everybody else already knows something you don't. None of those voices are running the 3-question checklist. They're just reacting. I've watched grown adults, smart ones, capable ones, make the exact same mistake I made decades ago, buying a name purely because it feels cheap. I think about a fellow I used to coach a bit years back. Sharp guy, ran his own small business, understood spreadsheets better than I ever will, and he bought into a stock purely because it had cratered from $90 down to $12. And his exact words to me were, it's got to bounce. It's just too cheap to keep falling. It kept falling all the way down to under $1 eventually. And when I asked him afterward what actually changed his mind to buy it in the first place, he couldn't point to a single fact about the business. Not one, just the chart. And the feeling in his gut that a big round number drop meant a bounce was owed. The market doesn't owe anybody a bounce. That's not how any of this works. And the sooner you make peace with that, the calmer your whole investing life gets. And here's a phrase I'd like you to ban from your vocabulary entirely. Cheap. On its own, that word means nothing. Plenty of stocks that look cheap at $50 looked even cheaper at $30, then at $10, then at $2, on their way to essentially zero. Cheap isn't a fact. It's a feeling, and feelings make terrible investors. Here's the bigger lesson underneath all of this, and it's the one I actually care about more than any single stock pick. This whole business rewards patience and punishes impulse over and over again with almost boring consistency. The investors who do well over a lifetime aren't the ones who catch every bottom perfectly. Nobody does that, not even the professionals, no matter what they tell you on television. The investors who do well are the ones who know their exit before they ever buy, who treat a falling stock as a question to investigate rather than a bargain to grab, and who are willing to look a little boring for a while in exchange for not getting wiped out. I think about it like tending a garden. You don't yank up every plant that looks a little wilted after one cold night, but you also don't ignore the ones that have clearly rotted at the root just because you remember how pretty they used to be. You check, you look at the actual conditions, and then you decide calmly, without panic in either direction. Or think of it like a coach benching a player. A good player who's having a genuinely rough stretch might just need rest, might come back stronger next season, and pulling them permanently over one bad month would be foolish. But a player who's actually injured, who keeps aggravating the same problem every time they step on the field, needs to sit until you actually understand what's wrong, not because you stop believing in them, but because playing hurt makes the injury worse. Your portfolio deserves the same honesty. Some of your holdings are just resting. Some of them are actually hurt, pretending you can't tell the difference. Out of loyalty to a name you've owned a long time, is how good money follows bad money right out the door. If this kind of thinking is useful to you, here's what I'd ask in return, and it costs you nothing. Take 5 minutes this week and run this exact 3-question test on whatever you actually own. Not what's trending, what's sitting in your own account right now. Write down honestly whether each one is green, amber, or red, and drop it in the comments below. I'd genuinely like to see how many of you are carrying more red than you realized. If you want a simple one-page version of this checklist to keep next to your portfolio, I put one together, and you can grab it for free using the link in the description. No obligation, no strings. Just something to make this easier to actually use instead of just something to nod along to. And if you'd like to go deeper, I'm planning to walk through this live with a group of people soon, working through real portfolios in real time. Details are in the description as well if that sounds useful to you. Either way, subscribe if you want more of this kind of plain-spoken thinking about money, because I've got a lot more of it. So here's where I'll leave you. 3 famous stocks, all down big, all sharing the same scary headline, and 3 completely different honest answers once you actually looked underneath. That's the whole game, really. Not being smarter than everybody else. Just being willing to ask the same 3 boring questions when everyone around you is either panicking or celebrating. Down a lot doesn't mean broken. It also doesn't mean cheap. It just means you finally have a reason to go find out which one it actually is. Do that calmly every time, and you'll be surprised how far it takes you. I'll be honest with you, I still catch myself wanting to skip the questions sometimes, especially on a name I've owned before, or one that reminds me of an old win. 40 years of doing this, and the pull toward a gut feeling never fully goes away. It just gets quieter, and you get a little faster at noticing it and setting it aside. That's really all this is. Not some secret formula that removes the temptation, just a habit sturdy enough to out-argue it, 3 questions at a time for as long as you're in this game.